Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I think the narrative in this market is, we've got a new administration. We've got some new trade policy focusing on tariffs. That's creating a certain amount of uncertainty in the market. Maybe immigration policy changes pending, also in bringing in some uncertainty into this market. And we've been told since day one the markets don't like uncertainty. So net, you got the S&P kind of pulling back about 7-8% from its recent peak. You've got the dollar a little bit weaker. But at the end of the day, what does this really mean for the economy? I guess we have to wait and see. But Tiffany Wilding, we're going to ask her that question. She's an economist in covering the North America for PIMCO. I was with her colleague, Mr. Clarida, last evening up in Stamford, Connecticut, talking about these markets. So got the PIMCO view from Mr. Clarida. Tiffany, at the end of the day, when you plug these things into your model, whether it's tariffs, and we'll find out more, I guess, April 2nd on tariffs, whether it's maybe some tweaks to the labor market in terms of less migrant additions to the labor market, how has it changed your economic outlook for 25?
Yeah, I think the bottom line for us is that, although you could have, medium-term better outcomes with more investment in the United States as a result of these various policies, there's going to be some near-term disruption. And that's simply because, tariffs raise costs. So they raise costs on investment as well as consumption. So if you're, trying to get more investment in the United States at the same time you're making it more costly, that is potentially problematic. Mm-hmm. But I think the bottom line for us is that there is some adjustment period that will happen. The tariff policies that we've seen have been, I think, much more aggressive, than anybody has expected. There will be some near-term price level adjustments, some near-term inflationary pressures from that, and we'll also see, growth and labor market outcomes, really decelerate as a result.
Tiffany, what did you make of the numbers we just got?
Yeah, so we'll have to obviously dig into the details on the income data. But I did want to, I do think the spending data, was a little bit weaker here. We got some of this from the retail sales report, which was incredibly strong, as I mentioned. Consumers, and so the fact that today's data, which includes everything, not only goods spending, but services, today's data suggests that consumers are shifting away from services at this point and spending focused much more on goods types of spending. And, we definitely think that is the result of their expectations that you will get higher tariffs. And so they're trying to front load ahead of that. And I think, that kind of belies, this kind of underlying weakness in the economy. You're getting a front loading behavior that's sort of propping up spending for now, but that's not going to last forever. So the question is, when does that wane and how much? And we do think that the higher uncertainty, plus higher prices, will result in consumers, really taking a step down in terms of growth. And it's been the high income consumer that has really been driving consumption growth over the last couple of years. And we think they are poised to, just kind of take a step down here as we have this higher uncertainty, lower equity prices, and we will see that moving forward.
How long do you think, Tiffany, that the lag effect is when, tariffs go into effect and then the other countries slap tariffs on our goods? And how does this kind of play out in the economy? Is it something that's a 3, 4, 5, 6 month type of process?
Yeah, well, I think it's different for different variables. So I think for inflation, what we've learned over, the pandemic and I would say the last several years, is that with the increased digitization of retail and commerce, you don't have these quote unquote menu costs anymore. So that was, kind of economist jargon for when you want to change a price, you literally have to print a new menu and there's some cost to that. So you might not change as quickly, but now you don't have to to do that. You can literally change in real time, if you have a digital platform. And so that results in you getting much quicker pass-through potentially to higher prices. Now, one of the things with this that the businesses will have to be optimizing for is that when you raise prices, you usually reduce volumes. And so they'll have to be, again, optimizing for that. I think there's some question around the extent to which these tariffs can actually be passed through to consumers. Consumers are not as strong as they were several years ago when they had big fiscal, paychecks in their accounts that, that helped fuel spending despite higher prices. So, I think those are the kinds of things that we'll be looking for. In terms of the labor market effects, I think it's really a question of how businesses and how this impacts their bottom line. How much of that price pass through, how much of the price increase can they pass through? If there's, much more margin compression, then they might be looking towards, optimizing, reducing, some of their labor inputs. And so that, I think will take a little bit more time to play out as we see how this goes. But, we think in the manufacturing sector in particular, you could see some, some furloughs and things like that, as these things are sort of passed through, through the hopper.
All right, Tiffany, thanks a lot. We really appreciate it. Tiffany Wilding, economist over at PIMCO. Let's just get a recap on these numbers, right? You had personal income for February jumping to 0.8%, but the spending slowing a bit to 0.4% versus expectations. Then you had the PCE index, so that is what the Fed winds up looking at on a year-on-year basis, coming at 2.5%, and the core, so you're backing out the more volatile numbers, that's coming up on a month-on-month basis to 0.4%. So as we digest, want to get more on this with Stephanie Roth, chief economist at Wolfe Research. All right, Stephanie, first blush, what's your takeaway from these numbers? What stands out?
Yeah, I guess two things. One is on the price perspective, we're starting off at a fairly elevated place, and this is before tariffs have a big impact. So we're in a tough situation, just given the extent of the tariffs that are likely to put in place. They could have an impact of nearly a percentage point on price inflation for the next year. Of course, Powell last week made it sound like they wanted to look through it, but at some point this could become a real challenge for the Fed. And then you are seeing a more sluggish consumer on the spending side as well. The income numbers are a little bit overstated. Some of that came from rental income and some other sort of one-off stuff from government. So I would look at the income as slightly less than the numbers would suggest. But all in all, you're looking at a consumer that is pulling back a little bit. And that's likely to continue even more so as the consumer becomes a little bit more concerned about the backdrop.
Stephanie, how do you think the Federal Reserve will look at this data? Will it give them maybe a little bit more confidence to maybe just kind of sit on their hands for a while?
Yeah, I think they're going to want to sit on their hands kind of either way. The policy backdrop is so complicated. There's two main things that they're likely to be looking at when we're thinking about what's going to happen in the next couple months. On the tariff side, of course, what gets implemented, and then how do inflation expectations react as a result? This is the primary transmission mechanism to which the Fed would initially become concerned. If you start to see consumers really become worried about the inflation outlook, which you miss, inflation expectations started to show a little bit of a flavor of that, that's going to make them want to become more hawkish than would otherwise be the case. And then they're also going to want to look on the immigration side, which people aren't talking about enough. But Trump this week ended the visa status for 500,000 people from Cuba, Haiti, Nicaragua, and Venezuela effectively overnight on April 24th. And that's going to be felt both from a real labor market perspective, but also in the non-farm payrolls data.
So, okay, so to that point, though, what's the transmission mechanism in that we get the sentiment kind of rolls over? When does that actually feed into the hard data? Because if you take a look, like a lot of President Trump's polling is still really strong. So there is this like divergence in terms of maybe where individuals feel the country is headed and then how they feel about their pocketbooks.
Yeah, and there's been a big discrepancy between consumer confidence and spending for a number of years at this point. So it's not as if confidence is going to be predictive of spending, but in this instance, I do think, at least directionally, it's telling you that people are getting more concerned. When does it feed into the real data? It's probably when the prices actually take effect. So when things become legitimately more expensive, based on our analysis, it looks like it takes about 3 to 6 months for prices from tariff implementation to prices actually showing up at the stores. So I would imagine over the summer is when consumers may really start to feel the pain. And that's when you really could see people pulling back even more materially.
Stephanie, I hate to go to, labels, but is it fair to label this tariff price increase that may occur in this U.S. economy as transitory, or is it something more than that?
I wouldn't use the word transitory. To be fair, I'm surprised that Powell used it as well, just given the whole background with that word.
Right.
I think it's right that it's a price level shock. The problem is, similar to the last supply shock, transitory was expected to be a short-term thing, call it less than a year. And we're likely to see the effects of this for way more than a year, because if you start to see the supply chain in autos get sort of snarled to some extent, then that feeds through into motor vehicle insurance. And we saw how long that took to feed its way into the inflation data. So I agree that it's a price level shock. It's not a sort of an ongoing inflationary spiral type of thing. But transitory kind of implies at this point that it's going to be very short-lived, and that's perhaps a little bit too optimistic.
Right. I feel like the distinction, though, is like it's a one-time price hike and then it stops versus keeps going up. And if it keeps going up, then that's obviously going to be more harbinger for the Fed. If it's just a one-time price increase, the economy is still growing. We're still in a good spot. Even if we grow 1.6, 1.7%, can we handle it?
Yeah, I think we can. And I think ultimately the Fed's going to have to cut as a result, because we're going to see the economy weaken on the back of tariffs, uncertainty. We're hearing, CapEx is starting to stall out pretty materially. So realistically, this is likely to be a growth shock, in which case the Fed can react dovishly. But they can't react until the data start to show that real weakness. And we're several months away from that, which is just a challenge for markets at this point, because the Fed kind of has to sit on its hands for a little while until they can actually react and come out a bit more dovishly when it's proven that this is more like a price level shock and the impact on growth is notably softer.
So, Stephanie, have you and the good folks over at Wolfe, have you materially changed maybe your GDP forecast, your inflation forecast to account for what appears to be pretty steady tariff policy here?
Yeah, we have. So coming into the year, we were a little bit above 2%. We were more optimistic on the growth. Once we realized that Trump was much more serious on doing tariffs, certainly earlier in the year, we were expecting it to be later. Once the Doge layoffs started they didn't actually play out, but the headlines weren't great. Once the negative stuff started to happen more so than anything positive that could potentially play out, we changed our outlook from 2.2 to 1.6. On GDP, inflation from 2.3 to 2.7. And realistically, the risks are that we might have to do a similar type of move again if you start to just see more of an impact from a tariff perspective.
I mean, yeah, it's not negative. I'm just saying.
No, it's not negative. Okay.
I'm trying. I vacillate between like glass half full, glass half empty. So it's like
Tom Keene has a good point, which is companies adjust, consumers adjust, markets adjust. You have to give everybody some more credit here.
Yeah, well, I think that's right. I think the economy will adjust, and I think we'll still grow. It's just a slower pace. We've been growing in an environment where growth has been 3% or above for the past couple of years. Yeah, so we just have to have a level shift down.
It also just depends on what that transition period looks like. Like, is it a couple months? Is it a year? Like, is it 6 months? Like, that really then depends on how maybe you asset allocate, or like what that growth trajectory winds up looking like.
Yeah, I think that's fair. For much of this year, I would be sort of concerned from an equity perspective. I think we might see a lot more volatility. At some point, it might be abundantly more clear that there's a lot of sort of risk priced into the markets, and then it would make more sense to take a sort of a stab at it. Right now, it just doesn't feel like enough is in the price, just given the tariff news that's likely coming.
Stephanie, thanks so much for joining us. Always appreciate getting your thoughts there. Stephanie Roth, chief economist at Wolfe Research. She got a master's in statistics.
I didn't even know you could get a master's in statistics.
You could not pay me nil money to get a master's in statistics.
Wow.
I had one course at business school in statistics. First quiz, I got a 7 out of 20. Why? Because I don't like statistics. And B, I slept out the entire weekend at Cameron Indoor Stadium to get season tickets to Duke basketball.
Well, I mean, like, there's priorities.
Totally worth it.
You gotta do that.
Worth it.
I think I took a statistics class.
Yep.
And I say think because, like, I actually don't remember. I think it was my best friend and her boyfriend, and I think that maybe he helped us.
Yeah.
With that the testing.
You can't do that for a living. All right, joining us now in our studio, which is a treat, Lauren Goodwin, Chief Market Strategist at New York Life Investment Management. So we got some inflation data today. It kind of came in line with expectations. Anything in the economic data recently that's jumping out at you and maybe changing the way you're thinking about these markets?
It's really difficult to take the today economic data and tell us much about the markets moving forward because we're in a really interesting and awkward in-between spot. We know that policy uncertainty is changing the way that businesses and consumers think. We don't know the extent to which that will impact the hard data. And so as we think about asset allocation, we're thinking about a couple of different themes in relation to data like this. One is, how do you build resilience in the near term to what we expect to be a relatively meager equity market backdrop? And the second is, what do we see happening that we can really anchor on long term? And as we approach Liberation Day, as it's being called, I think investors could be forgiven for not feeling particularly liberated. But as we approach Liberation Day, even if tariffs disappeared from the policy framework, there are megatrends in place related to supply chains and AI that are on their way. These are things that we believe we can allocate around regardless of the near-term volatility.
See, I feel like Lauren was someone who definitely did well in statistics.
I did really well in statistics.
This in no way surprises me.
When you got into like the seventh, eighth order, like applied econometrics, that's when I was calling.
Yeah,
Uncle.
totally.
Forget
I mean,
that.
that's like, for me, I actually sailed past that part. It was the next part no, I'm kidding. I don't know what you're talking about. Okay, so then the question that I've kind of been wondering, and I should point out the futures are around the lows of the session right now. Will Wednesday be a clearing event? Like, will it be a clearing event for the market, or it's just going to be more volatility and adaptation after that?
I think many of the answers that I've heard from the program already today suggest that it can't possibly be a clearing event. It could be a clearing event for Wednesday and Thursday. And then on Friday, we get a labor market report that's going to start to show the impact of government layoffs. And so it's, again, I honestly think that if you gave me a spreadsheet that said, these are the tariffs that are going to be implemented on these countries on this timeline, I've heard investors say, that's all we need, then we can do the math. I don't agree. We don't know how countries are going to react. And frankly, there are places in the world that have a lot of leverage on the US economy. And so even though some clarity over the path of tariffs, if we receive that, can be helpful for those next steps to start locking into place, the mere fact that we are on this path towards more regionalized supply chains, more energy and tech independence, that's a capital intensive trend that's on its way. It's going to happen regardless. And so I'm not really angering on feeling better on Wednesday.
Have you been rebalancing your portfolio, reallocating your portfolio, de-risking it? Have you done anything to kind of your recommendations?
We're in the camp of recommending actually pretty significant changes to a multi-asset portfolio. And just to give a little bit of backdrop, if you look back in the last 15 years, knowing what we know now, your ideal asset allocation would be 90% US large cap growth equity. And frankly, even in 2021, 2022, we, the investing public, were starting to say, oof, that lower for longer interest rate environment is changing. The world might look a little different. The AI boom bought us a little time of buy the dip, think about US large cap growth equity before all. That's changing. We're looking forward at a market environment that is more volatile, more inflation aware, more capital intensive. And that's an environment where I believe we need to be building more resilient equity portfolios, closing international underweights, looking to generate income within the equity portfolio, because we probably can only expect 5 to 7% on US equity this year.
So what does that mean?
Well, for starters, many of the investors, despite some of the news we've seen out of Europe, and frankly, despite a much quicker interest rate cutting cycle, have ignored the cyclical uplift in international equity. And so we're calling on investors to close those underweights. We're staying focused on quality and large caps, dividend payers, those that are lined up for stock buybacks. But we're also taking more equity-like risk in credit. And the reason for that is, as you see economic risks rise, or if we see that, certainly spreads will widen. We're already seeing it a bit. But on a 2 to 3 year forward-looking basis, I have very little concern that the US high yield market especially in the higher quality issuers, won't be able to pay back their debt. And so as a buy and hold strategy, getting 6 to 8% on a high yield bond portfolio, from my perspective, that's a real source of resilience in a multi-asset portfolio.
And how much duration would you typically like to take in this environment? Most people, I guess a lot of people have said kind of that belly of the curve, which is a term I learned from Lisa Abramowitz years ago, kind of 5, 6, 7 years, that kind of thing.
Lisa Abramowitz was also probably very good at statistics. I think we can agree.
I can see that. Yeah.
We are neutral on duration. So I just mentioned that from a credit perspective, we like shorter duration exposure, and that's because of the payback timeline. But in a portfolio as a whole, we have very low conviction of which part of the 3.5% to 5% Treasury yield range will stay in for any amount of time. I just think we're going to see more market volatility, market interest rate volatility, as these policy changes come into effect. And so we're balancing short duration credit exposure with some structured product, and also with a little bit of exposure in long duration municipal bonds, which is where infrastructure is funded.
So you're not worried about the tax break going away for munis?
Not particularly, no.
Okay.
And that's
I am paying attention to that.
I know. Well, okay, let me just. So usually we have a show from 10 to 12, which I won't be on today, but we have a Muni segment every Friday. And when we started doing the show together, I was like, Munis, man, I can't. This is too hard. And then finally Paul got me into it. So now when I see a Muni headline, I'm like, oh my gosh, the tax is going to go away. This is going to be terrible. Anyway, that doesn't worry you.
No, our teams feel high conviction that it's just highly unlikely to take place. But this is a part of the sort of credit environment, issuers in state and local governments that need funding for things that they are doing, that though you may see high yields gap out, for example, in the event of a major tax policy change, you still have a quality of issuance and an opportunity that we feel is meaningful. And interestingly, and perhaps more to the point, long duration municipal bonds, that 20 to 30 sort of infrastructure, 20 to 30 year infrastructure focus, those are taxable bonds. And so that's something that we're seeing not only for a retail investor base sort of thematically, but also for institutional investors who don't benefit from the tax breaks anyway.
Interesting. I'm looking at the WIRP Go function on the Bloomberg terminal, the world interest rate probability. It looks like the market's discounting, a couple of rate cuts this year. I don't know, maybe the data today influences kind of your viewing. How do you think the Fed will behave this year?
I think that the Fed is incredibly constrained by inflation numbers like this. There's nothing wrong with them. It's just very difficult to cut rates until we see a further deterioration in the other side of their mandate, the employment side of their mandate. And so I expect we'd either need to see significant disinflation, which I don't believe is likely, or meaningful deterioration in employment, or at least a 20% drawback in the US equity market for the Fed to cut more than one time this year. And so I do think that they will cut that one time. I think that staying on a path towards neutral is really important to them. But I think it will be challenging in this inflation backdrop to do much more.
Before I let you go, where do you guys think of like gold? For example, I mean, I can't get over this continued record move. And I look back and what gold was doing back in 2016 when we had another bout of uncertainty with President Trump, and it's like half of what it is now. I wonder how you guys talk about it.
So on a personal basis, we, of course, are very, very careful with our personal accounts as sort of institutional investors. But this was one of my buy and holds that I placed in September, and I'm feeling really good about it.
Nice.
But for institutional portfolios, for the average retail investor, we are advocating a satellite exposure to gold, actually as a function of inflation and volatility awareness, effectively. That in an environment where you can expect more sort of geopolitical dynamics, a little bit of concern about inflation, that satellite exposure makes sense. However, it really should be treated like a satellite exposure. This is a volatile and multifaceted asset class that most investors, frankly, don't have a ton of understanding on, and it's very impacted by central bank policy, which is also on the move. And so if you put it in the bucket of making an equity portfolio more resilient to the changes that we see going on, that's how we classify gold.
Lauren, so great. She's the best.
Yep.
Thank you so much. It's so good to see you. Lauren Goodwin, Chief Market Strategist at New York Life Investment Management.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Sevasti Balafas, CEO of GoalVest Advisory, based here in New York City. She joins us here in our Bloomberg Interactive Brokerage studio. So coming in studio on a Friday, 2 gold stars for you. So I'm just letting you know that's big. So how do you think about that outperformance, Sevasti, of European markets, international markets, or many international markets vis-a-vis the U.S. this year? Is this something that's sustainable from your perspective?
First of all, it's been very welcome for a long time. As you know, the U.S. markets have outperformed European markets. And will it last over the long term? I still am a believer in U.S. large tech long term. But over the next 12, 24 months, I do think that spread between the U.S. outperformance and the international or European outperformance, that spread narrows. Of course, the big investment in trillion-dollar investment in defense is certainly going to help those economies and those markets. But the same reasons why we didn't love or weren't overweight Europe 6 months ago, some of those reasons still persist. So we do see that spread narrowing. Am a believer in long-term U.S., but over the next 12, 24 months, do see some more room for growth in Europe.
Is the belief in U.S. stocks really tied to the AI trade, or do you think it broadens?
It absolutely has broadened. I mean, even if you look year to date, of course, the S&P 500 is down, the large cap tech is down, the Mag 7 is down, but you're seeing strong healthcare performance. The dividend stocks, those are up year to date, and I do think that continues. So I do see a broadening happening.
So peak to trough we had earlier this year, about a 10% correction, pullback in the S&P 500. How did you view that? Was that something that's just kind of a welcome, healthy part of a longer-term bull market, or does it signal something more for you?
10% is normal. Actually, more like 14, 15% is average intra-year decline on any given year, right? So the 10% pullback, we can't forget we had the 20+% in 2023, the 20+% in 2024. So it was almost par for the course. It wasn't unexpected.
I thought it was just me being a great investor.
Oh, well,
when
that's also
when I looked
true.
at my 401k, I said, wow, boy, you're good.
I know.
But maybe that's just the market lifting all boats.
Yeah,
Okay.
no, that's kind of what happened to me. And then my husband, who's now freaking out a little bit. I'm overstating. But so when you take a look at the benefits, though, where do you hedge the risk at the moment? Like, we talk about gold stocks doing really well. Like, right. Even if you have your long-term theme, even if you think European defense stocks will do well, where's that safe haven bid?
Yeah, that's a great question. Couple of things. In terms of having conversations with clients who ask me exactly that, it's a couple of things. So those conversations with clients that have cash needs coming up, cash has been great for us. We've put money aside. That's already been done. So anyone that has distributions coming up, cash aside, we have that. And in terms of longer term growth investors, so we still have our neutral weight equity allocation, but we have become more defensive by using those dividend stocks as an example. The other area is in private markets. So private credit, for example, you're not going to see the volatility that you have been seeing in the public equities markets, private credit, and then other securities, other alternative investments like structured notes, for example, that do well with volatility.
All in the structured notes. Unfortunately, there's some tax issues there. Sevasti, stay right there. You're going to hang with us. We're going to get the market open right now with Lisa Mateo.
And this opening bell report brought to you by Oppenheimer. Oppenheimer focuses the power of their thinking on you, creating customized plans to help achieve your goals. Put the power of Oppenheimer thinking into your investing, wealth management, capital markets, investment banking. All right, and these markets are open, and we've got red on the screen. S&P 500 down 0.2%, 16 points, 5,677. The Dow down 0.1%, 76 points, 42,221. And the Nasdaq down 0.4%, 78 points at 17,722. The 2-year yield, let's head over there, at 3.96%. That's down 2 basis points. And the yield on the 10-year, 4.30%, down 5 basis points. We have the Bloomberg Dollar Spot Index. That is little change. After point COMEX Gold, $3,112 an ounce. Now, as far as Bitcoin, it's down about 2.5% at just above 85,000. That is your Bloomberg opening bell report. Paul and Alex.
All right, thanks so much, Lisa. Sorry, I jumped you on that.
No problem.
I was going to talk about the sectors too. You got utilities
Yes.
and real estate doing well. When those two are doing well, there's a little bit of a safe haven bid in the market. Tech, consumer discretionary, industrials, communication services. So tech and the cyclicals underperforming just a touch. What are your clients asking you right now in terms of the tariff uncertainty and how to navigate that? And if it's a huge structural portfolio shift or just trimming around the edges?
It's trimming around the edges for us. It's not a big structural shift because, frankly, we don't have all the information yet. The announcement on auto tariffs the other day was a bit of a surprise. By the next day, we had additional information on that. So there's more and more information coming out, and the questions are around, is this going to last? How long will it last? Is this a negotiating tactic? What will we really see? But in terms of restructuring portfolios, it's tweak on the margin because we've had diversified portfolios. We're adding a little bit more, as I said, to defensive, but not making large changes. We just don't have information yet.
Yeah,
enough.
that's fair.
Let's talk a couple names here. Progressive Insurance. Now, when I got the Vespa,
Yeah.
the guy said, the salesman who was also a Progressive agent said, go get your quote from your insurance company. I got it over the phone. He says, I guarantee I can beat that by like 30, 40%. Sure enough, Progressive came through, and it is so easy. The app is awesome. So I've become a fan of Progressive Insurance because they insure the Vespa.
It's huge.
It's huge.
You know what's funny, talking about insurance companies? We'll get to the actual stock pick in a second. But on streaming, a lot of the insurance companies actually advertise. So my daughter now can sing and is into all the insurance jingles. So Progressive, Geico, Allstate, like she knows them by name. And I was like, wow.
It's such a competitive business that they advertise like crazy. Talk to us about reasons to own Progressive.
Well, exactly what you said. You sold it for me. Exactly what you said. So they are great with digital technology. That's certainly true. Number one, they're growing. So it's not only auto insurance, but they're really good with bundling, the cross-selling. So you mentioned some of that as well. And right now, when we talk about staying allocated to equities, but being more defensive, Progressive is a wonderful name. Expected double-digit earnings for this year. We've seen solid earnings from them in the past. Even in down markets like 2022, actually, they were positive. So it's a name that even if we're into a recession, you're still paying your insurance. It's a name that we like to have in the portfolio.
That's a good point. All right, thanks a lot. We really appreciate it. It's really great to get your perspective on how you're navigating this environment. Thank you so much for coming into the studio, too. We always love that when people come in. Sevasti Balafas, joining CEO of GoalVest Advisory.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Market's really been whipsawed by the news coming out of Washington, D.C. The folks there seem to be having the narrative here as it relates to financial markets. So we figured, let's get one of these folks on. Michael Haradopoulos, hope I didn't screw that up too badly, Republican representative from Florida in the U.S. Congress, joins us here in our Bloomberg Interactive studio. Michael, how do you guys think about, are you guys aware in Congress that when you guys, and when the White House talks about tariffs and economic policy, boy, that has a big impact on global financial markets. How do you guys think about that?
Well, look, it absolutely does. And one of my long-term goals is to offer certainty and stability to the markets. When I led the Florida Senate 12 years ago, we had a very challenging economy. We wanted to offer certainty, stability. We said no new taxes, no new fees. We're not going to make it easier for people to sue people. It really consolidated the Florida market. People flocked to Florida. We need to offer the same thing in Washington. But as you see with these tariffs, there's a lot of whipsaw, as you put it.
So the idea behind this, right, and I think that the Trump administration's been really clear, is to move from an economy that's reliant on fiscal spend to an economy that's reliant on private spend. And that is going to be a really difficult transition from anyone that you talk to. And I guess how much pain are you guys willing to take as that happens?
Well, I think the word is turbulence. There's going to be turbulence. You've already seen it in the market. It's been a little bit of a slip from this high mark earlier this year. And I think what the president's attempted to do is say we all learned during the COVID crisis that we're too reliant on foreign markets. We want to bring some of those jobs back. We also, of course, want to offer the middle class once again. Those are manufacturing jobs can do. But I think that challenge is there. Our Secretary of the Treasury has talked about making that transition, as you put it perfectly. I think you're going to see some challenges over the next few months. But one of the ways we do that is to reduce government government spending so that people have more money in their own pockets to make those capital decisions as opposed to let's just say the government making some of those big decisions.
So what do you think is as Congress comes back here, what do you think is the to-do list for Congress these days from your perspective?
Well, I think the great news, first of all, let's talk about the good news and the challenges. First and foremost, we realized that the border crisis was simply enforcing the laws. We've reduced the border crisis by 98%. And I like the idea that means we can actually maybe make some changes in the immigration law. There's some folks we need to bring in for what would be seasonal workers in agriculture, like my state of Florida, let alone people working in hotels, restaurants that are needed. Some Americans just don't want to do those jobs. That said, I think the bad news is there's going to be challenges because the president is saying we want reciprocal tariffs. Why are we still treating other nations like it's 1945 instead of 2025? These nations are up on their own feet right now. The EU economy is almost the size of the United States. We wanted to be treated fairly, whether it be on autos or food. And I think that's a common sense approach, that we get treated fairly, especially how generous we are around the world, whether it be our support in the Ukraine or, of course, whenever there's a crisis overseas, we always step up. That said, I think that the challenge is can we actually reduce spending, or at least focus on things that really matter? And I think one of the things that we're most focused on is how do we protect something that people have earned, Social Security and Medicare, and how do we also reform a program like Medicaid? I know it sounds great, but remember, Medicaid is welfare health care, and these folks pay nothing into the system. But we want to protect those folks on Medicaid or disabled or in a nursing home. But folks who are able-bodied, they need to get into this economy and contribute, because we're all paying a little bit artificially higher let's just say insurance rates for healthcare, because 1/3 of the population is getting free healthcare. There's going to be a cost shift when that takes place.
Yeah, but then they need the jobs. I mean, some of them have jobs, they just don't pay a lot. So it's not like they're just hanging out at home and like collecting Medicaid at this point.
No, I don't think that's the case. I think you're right. I think that we do have things like the CHIP program. That's where if you're working, you don't qualify for Medicaid, you get the CHIP program, so you can provide at least low-cost health insurance for your kids. I think those are the transitions we're looking at. And I think with Obamacare that does exist today, at least most people are paying something into the system.
How do people in Congress like yourself look at Doge and Elon Musk? I mean, you guys have spent your whole career getting to Congress. You guys are the bomb. Now you got this dude coming in. Who elected him to anything? How do you guys think about that in Congress, about encroaching upon you?
Based on your question, I might be the anomaly. I love what they're doing. Here's why. When I was leader of the Senate, we literally put everything online, from what we took in to what we spent to the people who got the contracts. I wanted to have that transparency. We are the sunshine state on legislation. I think the same should hold true for spending. It shouldn't just be Elon Musk. It should be all of us looking at where this money is spent. Every one of us works hard at this table to earn those dollars. The government should think as strongly about that same position. When you see them spending some money, and let's just say some dubious programs to be generous, you're wondering, is that really the best use of our dollars? You brought up the question of Medicaid. I think it's a legitimate issue. Those people who are on it, a lot of them desperately need it because there's no other way. When you take money into, let's just call them not such great programs, and you take away from needed programs, and you undercut the confidence in the government. So I think Doge is a smart way to make people think. When my wife says, hey, let's look at our credit card bill, I know I'm going to only spend on my credit card bill. Really? I should be spending on not some extra items. I think that transparency is essential to gain trust in the government, which is so lacking today. And as far as your question, the political question, look, I'm a former state legislator. I hated it when this federal government told me, the little brother to the big brother, hey, you got to do it this way. I think that all of us who came to the state legislature, remember, we didn't like it when big Washington told us what to do. We should not be hypocrites when we have that opportunity in Washington. Let's have those block grants back to the states. They're smart folks. They can make good decisions on healthcare, education, transportation, the environment. They don't have to cycle it through Washington to get the A-OK.
Are your constituents freaked out at all by the uncertainty? I mean, look at any sentiment data. Republicans, independents, and Democrats are all worried.
Well, I think part of that, and no disrespect, is a lot of the media buildup. Remember, there hasn't been a single...
No. Hold on.
There has not been a single cut to Social Security or Medicare at this point. We have not changed the Medicaid program at all. And so there's
But when you
this
hear
fear
Musk
factor.
talking about like $1 trillion worth of cuts, like we know where that's going to come from. It's going to be coming at some point from entitlements.
It is going to come from, first of all, the entitlements, the ones you've earned, are not going to be touched. Social Security and Medicare. Every one of us on this portal today have paid into that our entire working life. That's a pledge we made to folks. Medicaid's a little different program. And there's almost 100 million people on Medicaid. All we've said, where we really focus, at least I have, is saying people who are able-bodied and are choosing not to work should not be on Medicaid.
But it's not just that, it's tariffs, right? It's the worry of higher prices, even in the short term, and it's across the board. So are people coming to you and being like, look, I'm freaked out, what's going on?
I think people are freaked out a little bit, sure. There's a big change coming in government, but come on, when we run $1 trillion deficit, what kind of responsibility is that? Again, what I love is we're having this discussion finally of what is the role of government? Should we be spending in this program or that program? And let's all take a look at it, because some of these programs that have been identified by DOGE would have never passed the smell test if you actually brought some of those expenditures before a government committee.
Florida, everybody in this greater listenership here, greater New York City, has seemingly gone to Florida.
Paul's just jealous.
I mean, what's the attraction? I mean, the summer's hot. I mean, I don't. So talk to us about what's the. Is it still growing down there? Are people still coming down
I live
there?
in fantasy land. I love where I live. My wife says, "I say, what are you crazy? You're going to Congress? We live in Florida. It's the best place in the world." Remember, we have budget surpluses. We have one of the best education systems in America. We handle hurricanes when they do come, and it's just a fabulous place to live. And so we love it there. And I'm a former New Yorker myself. Grew up in Garden City, Long Island, and so when I experienced a winter in Florida after going to college, a place called Stetson, I said, I found home. And it's hot everywhere, folks, in August, let's be honest. And I'm willing to take 1.5 really bad months for 10.5 great months in Florida. Come on down. Eventually, you're all going to come.
Yeah, yeah, exactly. It seems we're...
No, I'm too pale. I can't do Florida.
Yeah, you can't do Florida. No way.
No,
I'm sticking with the Jersey Shore. But no, there's a lot of folks heading down there. Michael Haradopoulos, thank you so much for joining us. Republican representative from the great state of Florida in U.S. Congress. Thank you for coming to our studio. Appreciate it.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
I'm looking at the 30-year fixed mortgage as per the Mortgage Bankers Association, 6.71%. It's down from over 7%, kind of back where we started the year. So it's come down a little bit, but it's still not at a level that a lot of folks say will free up this market. I don't know. Selma Hepp, chief economist, CoreLogic, she does this stuff here. She worries about the mortgage markets. So, Selma, you see some of the economic data here over the last couple of weeks. How does that inform kind of where you think the Fed is going to go with their interest rate policy this year?
First of all, a slight correction. CoreLogic is now Cotality, so we have a brand name change here.
Oh, nice.
Yes.
All right, well, we'll just go ahead and blame Eric for that.
Some consultants somewhere along the way came up with that. That was their job. They got paid to do that.
Okay. Well,
okay. And
good.
what's the new firm name?
Cotality.
Oh, fantastic.
Totality. All right.
All in. So what do you think about our Federal Reserve here, Selma?
Yes, well, thanks for having me on. Well, Federal Reserve is in a really it's in a pickle in a sense because it's trying to maximize employment while stabilizing prices, and neither one is moving in the direction really in which they would want to. At their last meeting last week, they were talking about higher inflation going forward, so they don't expect reaching that 2% target until 2027. At the same time, concerns are building around the job market, meaning that we can have higher unemployment going forward. And, when you're talking about large layoffs, that never bodes well for consumer sentiment. And so consumer sentiment has weakened at the moment, and that is not good for the housing market. We did see mortgage rates come down lower over the course, you mentioned from that 7% in January. That is very helpful. And what's also helpful is that mortgage rates have been stable over the course of last month, because there's nothing worse than mortgage rates going up in the middle of spring home buying season. And that is what we saw last year. So mortgage rates at least are a little bit helpful in terms of the housing market at the moment.
You really can't put mortgage rates aside, but how's affordability aside from mortgage rates? Like, are prices coming down to reflect this uncertainty that consumers feel?
No, home prices are still stable. They've been pretty flat for the course of last 7 months, and we did see this little bump in February, reflecting entry into spring home buying season. It was a little bit weaker than we traditionally see in February, but it's still going up. And there are still markets where you guys are up in the northeast region of the country where home prices are up some 9 to 10% on a year-over-year basis. So where incomes are strong, we do continue to see relatively strong home price appreciation. The weakness is really in the southern markets in Texas and Florida, where we've talked about this over the course of last year. Markets and the demand for homes have really weakened, and that's reflected in lower and declining home prices.
Home affordability, I mean, and that's a term that I've really come to understand a little bit more fully over the last several years. It kind of goes to the issue of, hey, the houses are expensive out there, and now we've got mortgage rates high. That makes home affordability really, really difficult. How long do you think that's going to persist, Selma?
Well, I think we're already seeing pressures building up, and that's why the rate of home price appreciation has slowed and home prices have been flat, because it's really difficult for people to make that new mortgage payment. Our estimate is that a mortgage, just principal and interest over the course since the onset of the pandemic, has gone up some 62% on the same home, exactly same home. Your typical mortgage payment is now up 62%. But the other issue, and that's really causing concerns for some markets that are more prone to natural disasters, is that you have cost of insurance increasing so much. And also in some markets that have seen a lot of appreciation, you now have much higher property taxes. Mm-hmm. So that's the component that's variable. It's not fixed. And that's really starting to weigh on more on affordability in some markets.
Selma, before we let you go, this is not taking into account lumber, steel, and copper and aluminum tariffs. How much will that increase new homes?
Yeah, so we did an estimate, and we think about 10% increase in material costs over the course of next 12 months. Now, it's interesting, there are different components for residential. The biggest concern is appliances. For commercial, the biggest concern is steel and cement. But commercial sector has been slowing, particularly when you think about multifamily. That has been slowing. So the pressure on those prices is going to be a little bit less, simply because the demand for those type of products is not as high as it was over the course of the last few years.
All right, Selma Hepp, thank you so much. We appreciate that. Selma Hepp, she is the chief economist, and the new firm is Totality. There you go. Cool.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now, let's hit the newspaper segment, the always popular newspaper segment with Lisa Mateo. Lisa, what do you have for us today?
Okay, Paul, I know you're not going to know this, but Alex, did you notice what Oprah was wearing to the Oscars?
No, but I want to know. Talk to me. Wait, was it a suit?
Yes, you're onto it. Okay, it wasn't an evening gown, so she was wearing this long black skirt, tuxedo-type blazer, white shirt with a tie. And the tie was like the staple, because women wearing ties, it's not something new. Remember Diane Keaton, like she wore the ties all the time. Right. Yes. But it's seeing this resurgence. So you have like Zendaya, Zoe Saldana, like they're starting to do this. I was on the 2025 runway. So the Wall Street Journal really gets into it. They have like a bunch of listings, how they can be as high as $255, some as cheap, maybe $28. But they get into the history behind it. Like in the 1830s in Paris, women needed permission from the police to wear a tie.
Oh
really?
My God, yes. That's amazingly wrong.
Yes. But I don't know. I think I would I like the thin ones. I think I would do that. Like I've seen people here wear it too.
John Ferrer wears the thin tie, and he wears it very well.
But he does wear it very well.
I would totally do that.
No,
look.
I don't like it. Sorry.
You don't like the women tie thing?
No. Can I ask an adjacent?
He's wrong. He's wrong, by the way. But that's fine. You can have your opinion, but it's wrong.
That's my opinion. Yeah. Can I ask an adjacent Oprah question?
Yes, please.
Do we know? Has it been reported whether she's doing like the Ozempic kind of Wegovy thing?
She's talked about it because she had the whole special.
Right.
Yeah.
Okay. So she's okay.
Yeah.
Just wondering.
She looks phenomenal.
Yeah, she does. Okay, great. Just
but she looks phenomenal in a tie.
Oh, she.
Yes. Way to bring it back.
What else are you looking at?
Okay. President Trump's childhood home. I didn't know this, but he had this, he lived in a 2-story, 2,100 square foot. It's like a Tudor style residence in Jamaica Estates in Queens until he was like 4 years old. His father actually built it in 1940.
It's a nice area, Jamaica Estates.
Yeah. But it was sold at a steep discount. Okay, the reason why, well, it was sold for $835,000, right? It was less than half of the $2.14 million that it was sold for back in 2017, but it's been unoccupied, right? It's run down. And you said the area is nice.
Yep.
So the neighbors are like, this is an eyesore. This is horrible. So they started trying to keep up with like the lawn. And then you have like 30 stray cats that are like wandering around this house, and they're feeding the cats because they feel bad. And it's become this whole thing. But the person who owned it before, they actually used to rent it out as like an Airbnb for like $800 and something a night.
I love that the neighborhood started. I love that. That is so awesome.
So the neighbors were like pitching in. So now it was finally sold after being abandoned for a while. But it was
that's going to be, you put $1 million into that thing, which somebody will, and it's going to be
And they're they have
fantastic.
the dumpsters out
Yep.
there tearing everything down. So that's interesting. I didn't even know that he lived there till he was like 4 years old.
Exactly. Okay.
For those of you, are you guys on Facebook? I don't know.
No.
You're not? Okay.
I mean, I think I have an account.
Okay.
But I think I haven't been on it for 5 years.
I know. I haven't either. My daughter says only old people do it. So, so Mark Zuckerberg actually wants to bring back like the OG Facebook. Like when you would talk and when you see content from your friends instead of all these recommendations that you get. So they're introducing this Friends tab. It shows your friends' stories, reels, birthdays, all that kind of stuff. What it kind of used to do. So it shows how they're going back to their roots a little bit. I mean, they've been trying to get popular. They've been falling to like all the other social media platforms.
So what is it now? So is it a news feed basically versus a friend feed?
Now it's like the recommendation, like it gets recommended on the algorithm, like what they think you would like, and they put that on your feed. So if you click on this Friends tab, it'll go directly to only what your friends are posting, so you can see that.
There's something very weird about this, isn't it?
I don't know. I'm looking.
They're going back to the OG way.
I'm looking at the stock, $1.5 trillion market cap, up 3% year to date, up 24% over the trailing 4 months. This has become a story that used to be all driven by subscriber growth and growth and growth, and then it became a cost-cutting story, which worked great for the stock. And now they're figuring out how to monetize Instagram, WhatsApp, all that kind of stuff.
Well, now it's an AI play too for like a hyperscaler.
Yes, and now exactly right. Now they've got the AI thing behind them. All right, very good. Lisa Mateo with the newspapers. We appreciate that as always.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.